Markets are heading into the final stretch of 2025. Will we see a Santa Claus rally or more turbulence? Powell is signaling cuts, investor sentiment is shifting, and the stage is set for a pivotal Q4. Let's break down what to expect and answer some of your questions along the way. Welcome back to Navellier Market Buzz. So, Dad, we're heading into the final stretch of the year. What should investors expect for October, November, and December as we move towards 2026?
I'm going to try to walk you through this week by week. The second half of October is better than the first half, largely because earnings are coming out. This earnings announcement season is off to the strongest start in 4 years. Earnings are up over 14.6% on average for the S&P. The whole quarter, they're estimated 11, but we're off to a strong start. We've had big multinationals like General Motors and 3M announce, and I'm most excited about GE Vernova. Their results were stunning, and their forecast for their power generation business is just unbelievable. Their order backlog is huge. So that's helped lift the entire market. The other big news, of course, is gold has had its biggest correction in 12 years, but I expect that to rebound quickly. That was all technical in nature. So we're finishing the October on a strong note. November is seasonally much stronger than most months and even October. So if anything, we're going to accelerate into November. We often get an early January effect where the small mid caps take off. They've been doing, of course, incredibly well this year. That's very healthy. And typically we rally right up to Thanksgiving. Thanksgiving is a happy time of year. People get together for friends, family, football, and food. And that positive sentiment seems to help the stock market, helps investor sentiment. As we go into December, it will get a little bumpier just because of tax selling. A lot of people like to harvest their losses, cut their capital gains liability. But the last week of December, between Christmas and New Year, is spectacular. And then I expect a strong start for the year. So I like to tell people this is lock and load time. We've placed our bets for earnings announcement season. We're going to let those earnings one by one drop kick and drive the stocks higher. And I just tell them to enjoy the ride because this seasonal strength is quite incredible. And I'm shocked how well some of the big U.S. multinationals have done. That this stock market is trying to broaden out.
Are there any risks that could derail an end-year rally?
The main risk would be something extraordinary. And when I wrote this Barron's editorial forecasting an 8% rise in the S&P for the fourth quarter and an 18% rise next year, the only risk was a potential black swan event from the credit markets. And we had that for a day or so with Jamie Dimon's cockroach comment. Obviously, Jamie Dimon was upset that JP Morgan had to write off $3.4 billion in loans in the third quarter, including $170 million in a company Tricolor, which was a subprime auto lender that filed for liquidation. There's no doubt that the loan losses are rising, okay? But they still seem to be contained. And, in a previous issue of Navellier Market Buzz, we were talking about Capital One, and their results were fine, even though their loan loss reserves went up. So, these companies plan a certain default rate. But we are going to get key Fed cuts starting the last week of October. We're going to get another cut in December at the next Federal Open Market Committee meeting. And the real key is to start lowering rates to help the 50% of Americans that have debt issues.
Which sectors usually hold up best in Q4?
It's not so much a seasonal thing. What you'll see is if it gets cold, the natural gas stocks will do very, very well. Basically, when you invest in natural gas, you like to have a freezing cold winter and a hot, miserable summer because it makes demand go up. Natural gas is used to generate electricity and heat homes, of course. When you have these cold fronts, you want it also in a big metro area. So let's just say, I don't know, Spokane, Washington is cold. No one cares about that. They want Chicago to freeze over, New York, the Northeast, Washington, D.C. They want freezes in Texas. That kind of cold weather in big metro areas, that's what helps natural gas. Okay. The demand for new pipelines and midstream is up sharply because they're rushing to supply the gas to all the data centers. But I would expect utilities to be firm. I like the independent utilities that sell the excess power and have more profitability. But utilities are going to be firm. Um, this is still not really a sector market. Even in tech, I got to buy the best semis, the best networking companies. I just can't buy the whole sector. So stock picking is thriving this year versus sector management.
While we're talking about energy, one of our subscribers wanted to know what your thoughts are on crude oil prices this quarter.
Well, crude oil obviously fell below $60 a barrel due to excess supply. But President Trump just signed an order to put 1 million barrels of crude oil in the Strategic Petroleum Reserve, so that might tighten up supply a bit. Furthermore, ExxonMobil is exporting crude oil from Guyana all the way to India because the U.S. wants India to use less Russian oil. So it looks like the supply is trying to tighten up, but we are in the fall and winter months, and that is when demand is lowest. And then demand starts to pick up in February, March, and then prices naturally rise. So a lot of the lull you see in crude oil right now is just weather related. And the other thing is the rest of the world is kind of in a recession. Asia is very lackluster. I know China says they're growing. Domestically, they're not doing well at all. Deflation ravaging their economy. Europe is definitely in recession, okay, especially Northern Europe. Spain and Portugal are probably the only exceptions. So when economic activity is lackluster, demand drops. So you've got the global economic slowdown, plus weather is mostly impacting crude oil. But in America, we're growing. Last I looked, 3.8% GDP growth, and next year we expect to hit 5%.
Do you expect any rate cuts for 2026?
Absolutely. I'm expecting a global interest rate collapse. And the reason is Asia is not growing. They're not having kids. Japan has the highest birth rate in Asia, but not enough to replace their households. Northern Europe is the same. Spain and Portugal are growing from immigration, but the rest of Europe is stagnating big time. France is totally dysfunctional, about to fall into recession. And then, of course, Germany is in the third year of a recession. We have this global economic slowdown. The deflation that has characterized the Chinese economy since May of 2022 looks like it's getting worse based on the recent real estate data. So I'm just expecting that deflation to spread around the globe, and that will cause interest rates to fall further. But we're going to get a dot plot in December. Okay, we'll see where the Fed's at that time. But I do expect rate cuts in the new year, largely because of the global interest rate collapse.
So now let's move on to some subscriber questions. One of our subscribers wanted to know, what are some alternative safe havens to gold?
Well, gold is one of the best, but as people learned recently, it's volatile. And so when gold contracted over 5%, a lot of our gold miners contracted over 10% intraday. But I do want to assure everybody those gold miners have very good sales and earnings, and those sales and earnings will lift the stocks. But gold is definitely the best. You can go to industries that are, we call them ostrich stocks with a head in the sand and are oblivious to everything else. So a good example of an ostrich stock is Costco. It caters to fairly wealthy households, very strong same-store sales growth. Monopolies are good places to hide. Navellier is clearly a monopoly. So you want to look at high-margin companies that dominate their business, and you want to make sure their margins are expanding. We have a portfolio at the management company called Defensive Alpha that buys these ostrich stocks. And we typically buy up to 20. And if we can't find 20, we'll have some cash reserves. So technically it's a tactical portfolio because the cash reserves will vary. But yeah, I would recommend ostrich stocks in addition to the gold stocks.
And what's your take on Scott Bessente's plan to revalue the gold at Fort Knox?
Well, first of all, Scott Bessette came out and said the gold is in Fort Knox because there's, in the world of the internet, there are some rumors that maybe it disappeared. it would be hard to move. It's kind of heavy. The second thing is that he made it very clear he's not going to revalue it on the Treasury's balance sheet. So that's according to Bloomberg. So, the internet tries to get everybody excited with some scandalous headlines and all. And that's for lack of a better word, a false story.
While we're talking about gold, one of our subscribers mentioned that sometimes gold can be historical. How do you know that this isn't going to be another bust?
Because the buying pressure is relentless. It's mostly from central banks. In the past, this is several years ago, gold had a cycle tied to the Indian wedding season because I guess they were giving gold gifts for the weddings, and that was retail demand. But now this is institutional demand. Central banks have lost credibility in the world. They can't raise rates because of big deficits. People are wondering, is this currency good? So what they do is they just load up on gold, okay? And because gold is a legitimate reserve for the central banks. The other thing that's interesting is Venezuela raided their central bank under Maduro, and they were melting gold bars in Uganda that came from Venezuela that were interesting. Apparently, in World War II, when we had all the Liberty ships crossing the Atlantic, I guess the U.S. needed some oil from Venezuela, and we paid for the oil in gold bars. So Maduro's regime took those gold bars and were melting them in Uganda. Once you reach the central bank, your currency is worthless. And that's what's happened to Venezuela. So that's a good lesson. The other thing is, we live in a world where there's a lot of money in cryptocurrency. And although gold had a recent correction here, biggest in 12 years, it still surged 50% this year. And it's still perceived to be a lot safer than cryptocurrency. So I wouldn't be surprised if some of that crypto money ends up in gold as well. So people shouldn't worry about the cycles.
While we're on metals, any quick thoughts about silver and platinum?
Well, platinum is obviously an industrial metal. It's in your catalytic converters. Obviously, as we get more hybrid cars and more fuel-efficient cars, the demand can drop. So you got to watch the automotive industry. Platinum is very popular for jewelry, especially in Japan. It is heavier, though, than gold. It's mostly the industrial demand that's going to drive platinum. Silver is 3 times more volatile than gold. It has industrial demand, but it is very, very volatile. So hang on if you're buying silver. I'm not recommending any silver or platinum stocks now. Some of my gold miners do mine some silver as well. Silver recently approached an all-time high. It didn't quite get there, but it got close.
What about Franco-Nevada? How does that name look heading into Q4?
Well, Franco-Nevada has always been perceived to be one of the safest gold miners out there. Pays a dividend as well. I've seen it on my radar. It's technically acting well. I haven't bought it because I do a deep dive into the sales and earnings, and it wasn't as strong as the 11 other gold stocks I recommend. But if you like a nice dividend on your gold stocks, Franco-Nevada is a good choice.
Now on to stocks. We've had a lot of great questions that came in. What are your thoughts on SoFi and Robinhood right now?
Well, SoFi has very strong forecast of sales and earnings, and I have not bought it yet, but it's looking pretty darn good. Robinhood looks fine. It got volatile, but it's pretty simple. Robinhood has created a platform to buy crypto. The Securities and Exchange Commission, which is closed down right now with the government shutdown, has been facilitating them creating the platform to hold crypto where you have to have a segregated account. Our SEC chairman, Paul Akins, in his disclosure documents showed they had over $6 million in crypto. None of it was Bitcoin. So as the laws come out how to hold crypto in client accounts and segregate it, that really helps Robinhood. What Sam Bankman-Fried got convicted on, even though no investors lost money in the end, is he was commingling the assets, so your money would be mixed with somebody else's instead of a segregated account. And that's largely what they got him on.
Now with Sezzle, are you worried about any weak results because of the loan loss provisions?
No, not at all. Sezzle charges outrageous interest rates. They can have loan losses, but like Capital One, they'll be fine. So it says those loans are very short term. You can go to a store and you have to pay in 4 months or so. A lot of people are hooked on that kind of credit and they don't want to lose it. Says those loan losses are very minor.
What's your read on Galaxy Digital?
Well, this is an interesting company because it's making a transition from negative to positive earnings growth. I'm not sure their earnings are going to be positive this quarter because they're forecasted to be down slightly. Their losses from the analyst community have been cut to just a couple cents a share. Their sales are explosive. They're supposed to be literally 1,057%. That's ridiculous. Okay. This company is helping to house digital assets in data centers. So, we have this thing called a stablecoin, which is technically a cryptocurrency tied to the dollar. So you can use the blockchain. And the theory is as more people adopt stablecoins, we will be able to transfer money quicker and with fewer fees and all that stuff. Right now, when you do a Zelle or a wire transfer, there's a lot of parties involved. It can be fees as well. Not so much on the Zelle, but the wire transfers. So this is an explosive company. It kind of came out of nowhere. And it's too early for me to buy it. They have also missed analyst estimates. But let's see if that spectacular sales growth materializes. Let's see if they start to have positive earnings. So if they keep this growth up and their earnings are positive and they beat analyst estimates and the analysts continue to revise estimates higher, I will be interested in it. There was also an interesting thing that happened where PayPal apparently printed too many or made too many stable coins, and like 300 trillion or some ridiculous amount, and they had to unwind that as if it never happened. So this is kind of the Wild West. But because the U.S. is pushing stable coins, which again are tied to the U.S. dollar, I do think that this company might have a good future. But this is too early for me yet.
Can you touch on QBTS and SMR?
Okay, so I've written a lot of reports on QBTS as well as IONQ, and even we've touched on Rigetti. So I just should summarize what these are. IONQ packages data for quantum computing in something called QuidBits. D-Wave won the programming contest that Navellier had how to program quantum computers, and Rigetti's involved in encryption. In fact, they got an Air Force contract recently. IONQ and D-Wave have strong sales. D-Wave is the only one that beat analyst estimates, but that was 2 quarters ago, not the last quarter. All these stocks, because they don't have positive earnings growth, are going to be under pressure during corrections, and they have to burp. So if you see a stock go up 300%, do not be surprised if it has to give back 2/3 of that gain. It's normal. We saw this in the solid state wave many years ago. There was a stock called QS, which is a solid state battery company backed by Volkswagen and Bill Gates. It went nuts for a while. It's the same as QuantumScape, by the way. And even though they have some commercial applications now, it's nowhere near as strong as it once was. So your risk with the quantum computing stocks, the small modular reactor stocks like NuScale, is that everybody gets excited on the technology, but then they come back down to earth as we wait for the earnings to materialize. And a lot of people don't want to wait several years for earnings. Now, NuScale has explosive sales growth, okay? But their earnings are supposed to still be negative for a while. Glenn Youngkin, the governor of Virginia, was on Bloomberg recently talking about how Virginia is the data center capital, and they want the small modular reactors in Virginia. And so we'll see when they get built. But, under President Trump, we want nuclear power, but, you have to realize that you're investing in a technology. You're not investing in earnings at this moment. But with that said, I do like a D-Wave. I have it in accounts that clients ask me to buy it for. I don't have my normal managed accounts because I only buy things that earn money. D-Wave got a lot of clients excited. And I don't own NuScale, but it's perceived to be one of the winners when small modular reactors come to fruition.
And now let's talk about a few others. What's your take on Master Brand?
Unfortunately, that company's earnings are forecasted to decline 10%. Sales are supposed to decline 5.5%. They did beat the previous quarter, but yeah, this doesn't get me excited. This is what Stock Grader's for. We have a link at the bottom of Market Buzz to access Stock Grader. Click on the link and you can key in all your stocks. The other beauty of Stock Grader, you can save portfolios. So once you came in and save your portfolio, it's updated every week for you automatically.
And Asteria Labs?
Well, Asteria's sales are supposed to be up 82.5%. Earnings are supposed to be up almost 70%. This company has a good surprise history, positive analysis, comments, and revisions. So we have very smart subscribers. So congratulations. But that said, I don't have this under management yet, but it's definitely on my radar to be reviewed.
And lastly, Jeffries.
Well, Jeffries has up to $710 million in exposure due to the First Brands bankruptcy. And First Brands is a major auto parts supplier to AutoZone, Napa, O'Reilly Auto Parts, Walmart. When the company filed for bankruptcy, one of the creditors says we're missing 2. Whether that's true or not, we'll see. There's also a Department of Justice investigation into First Brands to see if there's any theft or bad accounting. So yeah, I don't know, of that $710 million exposure, how much Jeffries would have to pay, 300-400 million. But that's a big hit, and Jeffries isn't as big as a JP Morgan. So I would definitely stay away from Jeffries while the First Brand controversy persists.
And to wrap up, what's investor sentiment like right now? Are we still climbing a wall of worry?
Well, that's a really interesting question. You know, if you study my industry, the investment publishing industry, you'll notice there's two themes. There's the greed theme, let's get rich, whether we do it in AI stocks or quantum computing stocks or data centers. There's that theme. And then there's the theme that the world's ending. One of the things that's frustrating for people like me is the editors that are more negative often are some of the top sellers. So there's just a lot of people out there that buy these investment newsletters to tell them to do nothing. And I'm not in that camp. You know, I eat my own cooking. I do this research because, I invest for our family, for our clients. And so I'm obsessed with this. And all I care about is finding a silver lining critical path. But because the indices haven't done as good as stock picking, I think investor sentiment is not as strong as it could be. I think it's going to get stronger with the two Fed rate cuts. The other thing is investors seem to be getting hooked on these leverage ETF products where you can buy, 2 or 3 times NVIDIA. And these are high fee products with big spreads. So I urge caution on that. Okay. I'd rather you own the stock versus any kind of derivative product. But yeah, investor sentiments should get better and better in the new year. Now we have one major glitch. Andrew Ross Sorkin, of course, CNBC fame, New York, also writes for the New York Times, wrote a new book about 1929. And that was a severe market crash because some investors back then were leveraged 10 to 1. So he went on 60 Minutes and they basically painted a picture that there are parallels to 1929 to today. And I found that outrageous. That is not true at all. And although Andrew Ross Sorkin did signal that the market would peak out immediately, I just thought that was very responsible. Is there leverage? Yes. It's in the options markets. It's in the ETF markets. But the leverage is contained. Can you go on margin? Yes. But you can't do 10 to 1. You're going to do 2 to 1. So there are no similarities to 1929 to today. If we have any similarities, it's the go-go 90s. 98, 99, first quarter of 2000 were exciting times, and the market then peaked in March of 2000. So there is a similarity, but it's not 1929. I have no idea why Andrew Ross Sorkin went on 60 Minutes and said what he said. I found that to be very irresponsible. So I'm worried. I'm actually worried because CNBC is a big channel out there. I don't watch CNBC that much, but when I do watch it, they don't seem to be too happy, and that bothers me. We are going to hit 5% GDP growth next year with all the onshoring. So I think we should just grow and prosper from it. And GE Vernova is a classic example. Their order backlog is getting bigger and bigger and bigger. And this onshoring, the data centers, moving the pharmaceutical production in the United States, moving the automotive to the United States, this is all real.
Well, that's your Q4 playbook, a mix of opportunity and caution as we close out 2025. Thanks to everyone who sent in questions. We'll keep featuring more in upcoming episodes. Don't forget to like and subscribe, and we will see you all next week for a new video.